Hello guys, in this video we are going to be discussing about the amendments relating to CA Inter Income Tax applicable for May 2023 exams. Now before this we have already recorded two videos. In the first video where I discussed about the amendments in basic concepts, and the second video was about amendments to the 5 heads of income. In this video, we are going to focus only on Chapter 6A. Alright. Now, under Chapter 6A, there are two amendments. One amendment in Section 80DD, and then there is another small amendment in Section 80CCD. We'll take up the 80CCD amendment first, and then we'll go to the 80DD amendment. Let me tell you a small brief about 80CCD first. Now, under 80CCD, if your assessee makes a contribution to National Pension Scheme, Atal Pension Yojana, then he gets a deduction, right? And under 80CCD, we have totally three subsections that we learn: 80CCD1, 80CCD1B, and 80CCD2. Right. Now, when it comes to employer's contribution, the maximum limit is generally 10% of salary of employee. But in case the employer is central government, then the limit is 14%. Now that same 14% limit, which was applicable to central government employer, is now applicable to the state government employer also. This is the only amendment. 14% that was earlier applicable to central government employer, that same 14% is applicable to state government employer also. Okay. If you know the rest of the section, you can straight away go to the 80DD discussion. Alright, but if you want a little bit more knowledge on 80CCD, I'll give you a small revision over here. Listen to me. Under 80CCD, here my assessee is making a contribution to National Pension Scheme. Here we have two. Your first step will be to check whether your assessee is an employee or is your assessee a self-employed person. If your assessee is an employee, then you will see whether only the employee is contributing or is the employer also contributing. Okay, so whatever the employee is contributing, two sections are applicable: Section 80CCD1B and Section 80CCD subsection 1. If your employer is contributing, you will have to see who is the employer. Is the employer central government or state government, or is the employer any other employer? If the employer is central government or state government, here state government has been recently added. This is the amendment. Earlier we used to have only central government here. Okay, so the amendment is we also have state government over here. So now in case central government or state government is contributing, we have a different provision. Any other employer contributing, different provision. Now under 80CCD1B, for the employee's own contribution, maximum 50,000 deduction you can avail. Under 80CCD1, maximum 10% of salary is what you can avail. If the employer is contributing and if that employer is central government or state government, maximum 14% of salary is what you can avail. And if any other employer is contributing, then you can avail a maximum deduction of 10% of salary. Now, when you talk about employer's contribution, whether central government, state government employer, whether any other employer, this gets covered under Section 80CCD subsection 2. Okay, if the assessee is a self-employed person, then only own contribution, no question of employer's contribution, right? If I was an employee, then for my contribution also I would have enjoyed deduction. For my employer's contribution also I would have enjoyed deduction. So 10 plus 10, 20% minimum I would have enjoyed. So keeping that logic in mind, if I am a self-employed person, then I will not have employer's contribution. I will only have own contribution. For my own contribution, two sections are applicable: 80CCD1B and then 80CCD1. Under 80CCD1B, same maximum 50,000 deduction I will enjoy. Under 80CCD subsection 1, I will enjoy 20% of GTI as maximum deduction. By 20%, had I been an employee, I would also have contributed and my employer also would have contributed. For my contribution, you would have given me 10%. For my employer's contribution, you would have given me another 10% deduction. Now that I'm self-employed, there is no employer's contribution, so give me 20% maximum. That's the logic. Okay, you must be wondering, why am I writing about subsection 1B first and then subsection 1? There's a reason. You should always give first priority to subsection 1B, only then you should avail 80CCD1. The reason being because 80CCD1 is also subject to section 80CCE. You must be aware of 80CCE, which says that 80C plus 80CCC plus 80CCD subsection 1 put together should not exceed 1,50,000 limit. Right? So this 1,50,000 limit will spread across 3 sections put together. So when you have subsection 1b, you might as well utilize this first, because the subsection 1b is just for 80CCD, just for employees' contribution to NPS. You utilize this first, because if you utilize subsection 1 first, then this 1,50,000 is getting utilized. And if this 1,50,000 limit gets utilized over here, then the limit which will be left over for 80C and 80CCC will be even lesser. So that is why, because this 1,50,000 has to be shared between 3 sections, it is better that you utilize subsection 1b first and then you go to subsection 1. So under whether self-employed, whether or not self-employed, you always give priority to subsection 1b first, and only after utilizing 1b do you go to subsection 1. Remember, under subsection 1b, whether you're self-employed, whether you're an employee, doesn't matter. Under subsection 1b, the maximum limit is always 50,000. Alright, employees contribution, the other section is subsection 1, where maximum 10% of salary you can enjoy as deduction if your assessee is an employee, but if he is self-employed, then maximum 20% of GTI you can enjoy as deduction. Okay, now understand, we're using the word salary in all these places, guys. Now what do you mean by salary over here? Salary would be basic salary plus DA forming part. See, you're very used to writing basic salary plus DA forming part plus employees turnover based commission. But here I will not consider commission. Here salary will be just basic salary plus DA forming part. Understanding? Yes, so this was a quick summary of 80CCD. NPS contributions to Atal Pension Yojana. If I'm an employee, for my own contribution, under subsection 1b give me maximum 50,000, under subsection 1 give me maximum 10% of salary. Do not forget, subsection 1 will also be subject later to 80CCE. Under 80CCE, these 3 sections put together, you will have to restrict to 1,50,000. When I talk about employer's contribution, then if the employer is central government or state government, then maximum 14% of salary I can avail as deduction. If the employer happens to be any other employer, then maximum 10% of salary I can enjoy as deduction. For my own contribution, in case I am self-employed, under subsection 1b, maximum 50,000 deduction I will enjoy, and under subsection 1, 20% of GTI I will enjoy. See, let me give you one small example to help you understand this even better. Look at this question. We'll solve this to get a better idea on 80CCD. X is employed by the state government since 2009. For the previous year, his basic salary is 5 lakhs. He gets DA of 50,000 per annum, forming part of retirement benefits. Telephone allowance 60,000 per annum. His income of other sources is 2 lakhs. State government contributes 13% of basic salary plus DA towards NPS. Contribution of X towards NPS is 1,04,000. Besides, X deposits 96,000 in PPF, 5,000 in notified annuity plan of LIC. And let us say we have to compute the total income of our assessee. Okay, we'll go point by point. First of all, they've given us his income under the head salary. So he has basic salary of 5 lakh rupees per annum. Then he has dearness allowance of 50,000 rupees per annum. And then telephone allowance. If you recall, telephone allowance is fully taxable. See, reimbursement of telephone bill, reimbursement of mobile bills will be fully exempt, okay? But telephone allowance will be fully taxable. So telephone allowance of 60,000 taxable. Then, is there any other thing which has to be put under income under the head salaries? See, Mr. X is employed by the state government. His employer is contributing towards NPS. Always remember, when you talk about employer's contribution towards NPS, it will first be taxed under the head salary. For the employee, it will be taxed under the head salary. It will be fully taxed under the head salary. Only then you will give deduction under 80CCD subsection 2. For the employee, I'll repeat, it will first be taxed as salary because it is an income for the employee. It's a benefit for the employee. So first it will be fully taxed under the head salary. Then you will give a deduction under 80CCD 2. But what about for the employer? For the employer, this is an expense, right? Employer is making a contribution. For him, it's an expense. So for him, it's a business expense. It is relating to his business. So for the employer, it will be allowed as a deduction in the computation of PGBP. But for the employer, the maximum deduction that will be allowed will be 10% of salary of the employee. Okay, so from the employee's perspective, 80CCD is from the employee's perspective. For the employee, it will first be fully taxed under the head salaries because it's a benefit for the employee. Then you will give a deduction under 80CCD subsection 2, right? But when you talk about the employer, for the employer, this is a business expense. So for the employer, it has to be allowed in the computation of PGBP. Employer is making a contribution. For him, there's an outflow. For him, it's an expense. But it will be allowed subject to a maximum limit, and the maximum limit is 10% of the salary of the employee. Okay, so here we're doing the calculation for Mr. X. So for Mr. X, the employer's contribution will be taxed under the head salaries first. So employer's contribution to NPS, employer is contributing 13% of basic salary plus DA. Basic salary is 5 lakhs, DA is 50,000. 13% of this is being contributed by the employer. And how much is this going to be? This is going to be 71,500. This is employer's contribution to NPS. It will be taxed under the head salary. So now if I compute, the gross salary of our assessee will be 6,81,500. Okay, from this I have to remember to give standard deduction under section 16, 50,000, let's say. So the net number, the net taxable salary of our assessee is going to be 6,31,500. This is going to be the taxable salary of our assessee. So income under the head salary, we have 6,31,500. Then the question says his income from other sources is 2 lakh rupees. So the gross total income of our assessee is 8,31,500. Now from this you will subtract chapter 6A deductions, right? Now before we go to chapter 6A, what are the new things we've learned through this question? Telephone allowance is fully taxable. Telephone or mobile bill reimbursement of mobile bill, reimbursement of telephone bill will be exempt, but telephone allowance will be fully taxable. First learning. Second learning, when the employer contributes towards NPS, for the employee it will first be taxed under the head salary fully, and then under 80CCD subsection 2 you will get a deduction. How much deduction? If the employer is central government, state government, then 14% of salary you will get as deduction maximum. If the employer is any other employer, 10% of salary you will get as deduction at the maximum. For the employer, if you see, for the employer, it's an outflow, it's an expense. It's an expense relating to his business. So in the computation of PGBP, for the employer, the expense will be allowed, but maximum 10% of salary. Okay, that was a new learning through this question. Now coming to chapter 6A. What are the chapter 6A deductions possible over here? See, first of all, state government is contributing towards NPS. So which means we will have 80CCD2, guys. Right, for employers contribution we will have 80CCD2, right? And what is the meaning of salary for the purpose of 80CCD? It will be basic salary plus DA, which is forming part. The basic salary in this question is 5 lakhs and DA is 50,000, and the question says that this DA is fully forming part. So basic salary will be 5 lakhs and DA forming part will be 50,000. So 5 lakh 50,000 will be salary for the purpose of 80CCD. Now under 80CCD subsection 2, we'll have to see who the employer is. The employer happens to be state government. If the employer is central government or state government, then the maximum deduction which will be possible will be 14% of salary. That is 14% of basic salary plus DA forming part, 14% of 5,50,000. Which is going to be 77,000. This is a maximum deduction. But what is the actual contribution of the employer? The employer actually contributed 13% of salary, that is 13% of 5,50,000, which is going to be 71,500. So the maximum deduction is 77,000. Actual contribution is 71,500. So how much deduction you will get, guys? 71,500, right? It is well within the maximum limit of 77,000. So chapter 6A, section 80CCD subsection 2, you're going to enjoy 71,500 deduction. This is done. Then what about contribution of X? X is himself contributing 1,04,000. Now for employees' own contribution, you will have two sections, two subsections, guys. I told you right? For own contribution, I told you you will first apply ATCCD 1B, only then you will think about ATCCD subsection 1, right? Now, how much did the employee contribute? He contributed 1,04,000. First, you will apply ATCCD 1B. Maximum 50,000 is allowed over here. You will enjoy 50,000 here. Now, talking about ATCCD subsection 1, what is the balance contribution first of all? We contributed 1,04,000, out of which 50,000 we have already enjoyed over here. So how much contribution are we still left with? We are still left with 54,000. But under ATCCD subsection 1, what's the maximum deduction you can claim? Whether you're a government employee, whether you're a non-government employee, it doesn't matter. Under subsection 1, maximum you can claim is 10% of salary, right? 10% of 5,50,000, which will be 55,000. So under ATCCD 1B, you will get 50,000 deduction. Under ATCCD 1, you will get 54,000 deduction, right? Balance or maximum, whichever is lesser, obviously. Balance 54,000, which is well within the maximum limit of 55,000. So under subsection 1B, you will enjoy 50,000. Under subsection 1, you will enjoy 54,000. This is the easiest method to calculate ATCCD deduction. First subsection 1B, then see balance, how much are you left with, and what is the maximum deduction? 10% of salary. Out of these two numbers, you pick whichever is lesser, that is 54,000. So, section ATCCD subsection 1B, I will get another 50,000 deduction. Okay, but ATCCD 1, I will not write over there right away, because ATCCD 1 is also subject to one more section, which is what? It is also subject to one more limit which is given in ATCCE, guys. ATCCE says ATC plus ATCCC plus ATCCD subsection 1 put together should not exceed 1,50,000. Now, do we have any ATC deduction in this question? Yes, the question says he deposits 96,000 in PPF. PPF contributions for self, spouse and children come under ATC. So ATC 96,000 is eligible. ATCCC is contributing towards annuity plan of LIC. Towards annuity plan of LIC, RSSC has contributed 5,000. So 5,000 here plus ATCCD 1, what have we already computed? You're noticing, first I will compute here, then I will put it under ATCCE. So the sequence is like this: first subsection 1B, then subsection 1, then ATCCE. No confusion. Okay. So under ATCCD 1, what have we already computed? 54,000. So if you add this up, the total comes up to 1,55,000, but this we will have to restrict to a maximum of 1,50,000. This number you will take to your main answer. Under section ATCCE, maximum you can enjoy 1,55,000. So total, 1,50,000. We restricted it to 1,50,000. So now the total income of our assessee is going to be 5,60,000. Understood. So this question was just to help you understand ATCCD a little better. See, amendment is a very small amendment, but it's a very important section from the examination perspective. So I hope you are now clear, sort of, you've gotten a better idea at how exactly it is done. Okay, under ATCCD, what you will do is you will first apply subsection 1B, give 50,000 maximum over here. See, balance how much contribution you are left with, subject to a maximum of 10% of salary. So this subsection 1 number which you have will now be subject to ATCCE limit, which says ATC plus CCC plus CCD subsection 1 should not exceed 1,50,000. Perfect, guys. So this is it about our learning on this question. I think several concepts we've touched upon through this one question. ATCCD, please remember, first you will check whether your assessee is an employee or self-employed person. If employee, there will be own contribution and employer's contribution. Own contribution under subsection 1B, you give 50,000 deduction maximum. Under subsection 1, maximum 10% of salary only. Employer's contribution will first be taxed under the head salaries, and then you will get a deduction under ATCCD subsection 2. But for the employer, it's an expense and we will allow it under PGBP, but maximum 10% of salary only. This employer's contribution under subsection 2, you generally get 10% of salary as deduction, but if the employer is central government or state government, then maximum 14% of salary is what you will get as deduction. If your assessee is a self-employed person, he'll have only own contribution. Own contribution under subsection 1B, same 50,000. Under subsection 1, maximum 20% of GTI. Crystal clear, guys? Yes. So I guess with this we can close our learning on ATCCD. The question is also clear. Yes, I did ATCCD 2 calculations separately for employer's contribution. Employer's contribution I also added in the salary computation. Okay, and when I came to own contribution, I did subsection 1B first, then subsection 1, and whatever I computed under subsection 1, I also subjected it to ATCCE. Perfect. Taking you to the next amendment now in section 80DD. Before we go to the amendment, let us understand the existing section first. Okay, here I have an assessee. This assessee may either be an individual or a HUF. Okay, this assessee has a relative who may either be the spouse of the assessee or may be the assessee's brother, sister, parents, or children. This relative is dependent on the assessee and this relative is disabled. See, generally, when a person is disabled, this person can claim ATU deduction in the computation of his income. ATU deduction when assessee is himself disabled, assessee claims ATU deduction. But even though this relative is disabled, in his computation, he has not claimed ATU. Then, for this relative's disability, we have a medical certificate. This medical certificate acts as the proof of this disability. It also mentions the extent of the disability or the degree of disability, the percentage of disability, basically. All right. So, what are the conditions? Condition number 1, my assessee is an individual or HUF. Condition number 2, my assessee has a relative being spouse, brother, sister, parents, or children. That relative is condition number 3, dependent on the assessee. Condition number 4, that dependent relative is disabled but is not claiming deduction under ATU himself. Condition number 5, we also have a medical certificate which acts as a proof of the disability of the relative. Now see, because the relative is disabled, there will be a lot of expenses relating to the medical treatment of this relative, guys. But because this relative is dependent on the assessee would be bearing these expenses. So either the assessee is bearing medical treatment expenses for the treatment of this dependent disabled relative, or the assessee may also be making a contribution to a scheme of LIC or UTI or any other insurer. What kind of a scheme? A scheme where upon the assessee's death, this LIC, UTI or insurer will pay either annuity. Annuity means an annual sum of money, or this LIC, UTI insurer will pay a lump sum to the relative for his maintenance upon the death of the assessee. The logic is something like this. Right now, the assessee is taking care of this relative. But what if the assessee dies? Then what will happen to this dependent disabled relative? So for the maintenance of this dependent disabled relative after the assessee's death, now itself, during his lifetime itself, assessee is contributing to this scheme every year. Okay, now in case the assessee dies, under this scheme, this dependent relative will get money from the insurance company either in the form of annuity or in the form of lump sum. Alright, so this is my 6th condition. If all these conditions are fulfilled, what is the amount of expense? How much is the assessee contributing to the scheme becomes irrelevant. The assessee gets a flat deduction. Do you understand flat deduction? Flat deduction indicates what is the amount that the assessee has actually incurred over here. We don't bother about the actual amount. We straight away give a deduction, a flat deduction of 75,000. But if the medical certificate says that the disability is at least 80%, that is, if the medical certificate says that if the dependent relative is severely disabled, in that case, we will give a flat 1,25,000 deduction. This is the basic part of section 80DD. What are the conditions? Condition number 1, the assessee is an individual or HUF. Condition number 2, the assessee has a relative being spouse, parents, children, brother and sister. Condition number 3, this relative is dependent on the assessee. And condition number 4, this dependent relative is disabled but is himself not claiming ATU. Condition number 5, we have a medical certificate which is proving the disability and also mentioning the extent of disability. And condition number 6, either my assessee is incurring expenses towards the medical treatment of this dependent disabled relative, or the assessee is making a contribution to a scheme of LIC, UTI or some insurer. What kind of a scheme? A scheme which provides for the maintenance of this relative after the death of the assessee. In case the assessee dies, how will this dependent disabled relative maintain himself? So for his maintenance during the assessee's lifetime, the assessee is contributing to this scheme so that in case the assessee dies, this scheme will give money to the relative to help the relative with his maintenance. Understood? If all these conditions are fulfilled, then the assessee will get a flat deduction of 75,000. Flat deduction indicates what is the amount that the assessee has incurred on medical treatment is irrelevant. The assessee will get a flat deduction of 75,000, and in case the medical certificate says that the dependent disabled relative is severely disabled, that is, the disability is at least 80%, then my assessee will get a flat 1,25,000 deduction. Crystal clear with this, right? So this is my existing provision under section 80DD. Now under section 80DD, existing provision only, we have two more points which you should know. And these two more points are relating to the scheme. See what is happening as of now. The assessee is making a contribution towards a scheme of LIC or UTI or any other insurer. Under this scheme, the LIC, UTI or any other insurer will give either annuity or lump sum to whom? To that dependent disabled relative. Okay, when? After the death of the assessee. So you will see, when did the dependent disabled relative get this money? In this part of the discussion, this part of the discussion is slightly different from this part that we have learned. Here we spoke about the deduction which the assessee is going to get. Now we are going to talk about the reversal of the deduction. You will see that when did the dependent disabled relative receive the money from the insurance company? Let us say the dependent disabled relative has received the annuity or he has received the lump sum. You will see, when did the dependent disabled relative receive this lump sum? What is the timing? Did the dependent disabled relative receive this money during the lifetime of the assessee? Did he receive the money during the lifetime of the assessee? If that is the case, then whatever section 80DD deduction all this while this assessee enjoyed, everything will be reversed for the assessee now. Because it is wrong, right? According to the wrong, right, it seems. According to this situation, according to section 80DD, when should the relative be getting the money? Technically, the relative should be getting the money only upon the death of the assessee. That's the whole logic behind the scheme. But the assessee is alive during his lifetime itself, the relative is getting money. Now that is not what the lawmaker had wanted. That is not what their objective was. So if during the lifetime of the assessee itself, if the dependent disabled relative is getting money from the LIC, UTI or insurer, then 80DD deduction will be reversed, because now this was not the objective of the income tax department. Their objective was, what kind of scheme are we going to allow? Only those schemes where the dependent disabled relative is going to get money from the insurance company for his maintenance after the death of the assessee. So during the lifetime of the assessee itself, if the dependent disabled relative is going to get money, then it doesn't fulfill the objective of the lawmaker. So whatever 80DD deduction the assessee had enjoyed all these years, all that 80DD deduction will be reversed for the assessee in the year in which the dependent disabled relative has received the money from the insurance company. Okay, this was one part of the discussion. Till here understood? But what if the dependent disabled relative receives the money from the insurance company after the death of the assessee? Now, this is the genuine situation. Here there will be no tax implications at all. See, I haven't even reached the amendment till now. I'm still talking to you about the existing provision. Okay, do not forget that. So in case a dependent disabled relative is receiving money after the death of the assessee, now that is the genuine scheme. That is what the lawmaker had imagined while making this provision. So here there will be no tax implications. When do the tax implications arise? The tax implications arise only when the dependent disabled relative receives the money during the lifetime of the assessee. If he receives the money during the lifetime of the assessee, then whatever ATDD deduction the assessee had enjoyed all these years will now be reversed for the assessee. Okay, now let me tell you what the amendment is. The amendment is in totally 3 places. Okay, the first place over here, when I say that, what kind of scheme, only that scheme where the relative is going to get the money upon the death of the assessee, there they have made an amendment. Under this scheme now, according to the amended provision, when is the dependent disabled relative going to receive money from the scheme? Either the dependent disabled relative may receive upon the death of the assessee. This is the only point which was there earlier. Now, one more situation they have added. The dependent disabled relative under this scheme may receive the money even during the lifetime of the assessee, but after the assessee has reached at least 60 years of age and has stopped making payment to the scheme, then should the dependent disabled relative receive money from the scheme. Earlier, the rule was that the dependent disabled relative should receive money from the scheme only upon the death of the assessee. Now, not only that, one more situation we are covering where the dependent disabled relative may get the money from the insurance company during the lifetime of the assessee itself, but after he reaches at least 60 years of age and stops making payment. Because understand, this is a very, very practical situation. See, once the assessee himself reaches at least 60, see, I'm not saying exactly 60, I'm saying any time when he reaches at least 60 years of age, which means can be greater than or equal to 60. Right? So it's a very practical situation. If the assessee has reached 60 or more than 60, now the assessee may not be financially capable to take care of this relative. The assessee may not be financially capable to continue contributing money to the scheme. So the assessee has reached at least 60 years of age. During his lifetime, he has reached at least 60 years of age. He has stopped making a payment to the scheme, and during his lifetime, this relative may now receive money from the scheme because assessee is not financially capable to continue to provide for the relative. Practical, right? Possible. So these kind of schemes also we are covering. So under ATDD now, we are not only covering those schemes where the dependent disabled relative is going to get the money from the insurance company upon the death of the assessee. I am also covering those schemes where the dependent disabled relative is going to get money from the insurance company during the lifetime of the assessee, but after he has reached at least 60 years of age and has stopped making payment to the scheme. Okay, so this was the first amendment. Because of this amendment, now here also they have to make an amendment. So here, what was our existing provision? Our existing provision was that the dependent disabled relative, if he is receiving money from the scheme during the lifetime of the assessee, we said this is wrong. But now this may be right also. When will it be right? In case the dependent disabled relative is receiving money during the lifetime of the assessee, but after the assessee has reached at least 60 years of age and has stopped making payment to the scheme, then here there will be no reversal, because this also we are allowing now. Now, not only upon death we are allowing, we are also allowing upon the assessee reaching at least 60 years of age. Right? We are not, see, even earlier, if the dependent disabled relative was receiving money after the death of the assessee, we said no tax implications. Right? So this was anyways allowed. We were allowing the dependent disabled relative to receive money after the death of the assessee. Now we are also going to allow the dependent disabled relative to receive money after the assessee reaches at least 60 years of age and has stopped making payment. This also we will allow. Here no reversal. All other cases means even before the assessee has reached 60 years, even before that, if the dependent disabled relative gets money from the scheme, then whatever deduction assessee had claimed under 80DD all these years, it will now be reversed. You're understanding? See, this reversal point is still there. But when will this reversal point happen? This reversal point will happen only if the dependent disabled relative will receive any money from the insurance company during the lifetime of the assessee, but this condition is not fulfilled. If the dependent disabled relative is receiving the money after the assessee has reached at least 60 years of age and stopped making payment, there no reversal. Only if the dependent disabled relative receives money before the assessee can reach 60 years of age, only then there will be a reversal for the assessee. This is the second amendment. Okay, so first amendment, we are not only covering those schemes where the relative receives money from the insurance company upon the death of the assessee, I am also covering those schemes where the relative receives money from the insurance company during the lifetime of the assessee, but after he reaches at least 60 years of age and has stopped making payment to the scheme. Even those kind of schemes we are now covering. So, if the dependent disabled relative is going to get any money from the insurance company during the lifetime of the assessee, we cannot blindly reverse the deduction now. We will have to see then, when is the dependent disabled relative receiving the money? Is it during the lifetime of the assessee, but after he has reached at least 60 years of age and has stopped making payment, then there will be no reversal. But if it is after he has reached if it is before he has reached 60 years of age, then there will be a reversal. If the dependent disabled relative is receiving the money from the scheme before the death of the assessee during the lifetime of the assessee, but after he has reached at least 60 years of age and has stopped making payment, then there will be no reversal. Crystal clear till here as well? Yes. Now let me take you to one last point under 80DD. There's another existing provision, okay? The existing provision says, see, the assessee has been contributing money to the scheme, okay? Scheme of whom? LIC or UTI or any other insurer. The assessee has been contributing to the scheme for what? For the maintenance of a dependent disabled relative. Okay, the objective, the logic behind this contribution is that in case the assessee dies, then for maintenance of the dependent disabled relative, the scheme will pay an annuity to the dependent disabled relative or a lump sum. Okay, but what if the assessee in his lifetime itself, what if the dependent disabled relative predeceases the assessee? Predeceases means what? He died during the lifetime of the assessee. Assessee was saving money every year thinking, after my death, what will happen to my dependent disabled relative? But what has happened? The dependent disabled relative has died during the lifetime of the assessee. So now all the money which the assessee has paid to the scheme, his money only, the scheme will return the money back to the assessee, guys. In such cases, there will be tax implication for the assessee. The tax implication is whatever money the assessee had deposited into the scheme all these years, that money will now be taxable for the assessee. This was the existing provision. I'm still talking about the existing provision, okay? Here, one last point under 80DD. My assessee, all these years, he was contributing money towards a scheme, thinking after my death, what will happen to my dependent disabled relative? So all the money which he was putting into the scheme all these years is there accumulated in the scheme. But even before his death, during his lifetime itself, his dependent relative died. We saved the money for the dependent disabled relative, he died. So all the money which is there in the scheme will come back to the assessee now. His money will come back to the assessee. Now this money will invite taxation for the assessee. Whatever amount the assessee had deposited into the scheme all these years will now be taxed for the assessee. Okay, this was the existing provision. Now listen to the amendment. They have inserted a new point, a new subsection under 80DD. That new subsection says, in case a situation like this exists where condition number 1, during the lifetime of the assessee itself, but after he reached at least 60 years of age and stopped making payment, the dependent disabled relative has received money from the scheme. Okay, this is allowed, this is allowed now. Condition number 3, the dependent disabled relative, after receiving the money, has now died. He has predeceased the assessee. See, understand, there are two types of schemes that are allowed. Schemes where the dependent disabled relative gets money after the death of the assessee, and schemes where the dependent disabled relative gets money from the scheme during the lifetime of the assessee, but after he has reached at least 60 years of age and has stopped making payment. These two kinds of schemes are allowed. In these two situations, when the dependent disabled relative receives money, there is no reversal for the assessee. Reversal for the assessee arises only when the amount is received by the dependent disabled relative during the lifetime of the assessee, and that too before he has reached 60 years of age. Because after he has reached at least 60 years and has stopped making payment, then there is no reversal. After his lifetime, there is no reversal. Only here there is reversal. Okay, so two types of schemes we are allowing. Schemes where you're going to get money, where the dependent disabled relative is going to get money after the death of the assessee, and schemes where the dependent disabled relative is going to get money during the lifetime of the assessee, but after he has reached at least 60 years of age and has stopped making payment to the scheme. So in these two situations, there will be no reversals for the assessee. Only in other situations, if the dependent disabled relative is going to receive money, only there will be a reversal. Okay, now the situation is during the lifetime of the assessee, after he reached at least 60 years of age and stopped making payment, the dependent disabled relative received money from the scheme. We know that this is not going to attract any tax implication because these kind of schemes are also now allowed, right? But then what happened? The dependent relative predeceased the assessee. So because of this provision, now what will you say? You will say that because the dependent disabled relative predeceased the assessee, all the money which the assessee had put in the scheme all these years, please tax it. That is what you will start saying, because the dependent disabled relative has predeceased the assessee. But we want to avoid this because this situation is something which now the Act is allowing, right? So that is why the Act had to make an amendment. The Act had to say that in case these three conditions are fulfilled, then there will be no tax implications. See, generally, when the dependent disabled relative predeceases the assessee, then whatever money the assessee has deposited in the scheme, all this while will be taxed for the assessee. But now the amendment is that in case the dependent disabled relative has predeceased the assessee, but before his death, the dependent disabled relative had already received money from the scheme. How come? Because during the lifetime of the assessee itself, after he reached at least 60 years and has stopped making payment, now these kind of policies are allowed. So even though the dependent disabled relative has predeceased the assessee, he predeceased after taking the money from the scheme. Generally, dependent disabled relative predeceases the assessee. Now, whatever money assessee had put into the scheme is not taxable for him. But if the dependent disabled relative predeceases the assessee after taking money from the scheme, how come? Because during the lifetime of the assessee, after he reached at least 60 years, he stopped making payment. In such cases, the dependent disabled relative has received money from the scheme and then predeceased. Here there will be no tax implications for the assessee, no taxing all the money which was deposited in the scheme all these years, no need to tax it. Now understood, guys? Yes, if they did not put this amendment, then you would have said the dependent disabled relative predeceased the assessee. So come on, tax the entire money which the assessee has put into the scheme. We don't want to allow it because we are on one side saying that we are allowing another kind of policy now. So suitable amendment had to be made. That is why, according to the latest provision now, what is a rule? The rule is that in case a dependent relative predeceases the assessee, okay, then you will see the dependent relative before his death take money from the scheme, because during lifetime of the assessee he reached at least 60 years and stopped payment. If that is the case, if the dependent disabled before death already received the money from the scheme, then there will be no tax implications for the assessee. All right, to conclude, now look at this flow chart. In case a dependent disabled relative has received any money from the scheme during the lifetime of the assessee, then you will see, is it because the assessee has reached at least 60 years of age and has stopped making the payment? If that is the reason, no reversal. Otherwise, whatever ATDD he had claimed all these years will be reversed. If the dependent disabled relative predeceases the assessee Alright, and assessee receives a sum from the scheme, then whatever assessee had paid into the scheme all these years will now be taxed for the assessee. But in case a dependent disabled relative predeceases the assessee, and before the dependent disabled's death he had already taken money from the scheme, in that case there will be no taxation for the assessee. I can conclude like this, right? See, even now, there is no amendment in the amount and all. Amount and all is still 75,000, 1,25,000 only. The first amendment is that we are not only allowing those schemes where the relative receives money after the death of the assessee, we are also allowing those schemes where the relative receives money during the lifetime of the assessee, but after he has reached at least 60 years of age and has stopped making the payment. Second Amendment, earlier, if the dependent disabled relative received any money during the lifetime of the assessee, we used to say that it would be reversed for the assessee. But now, if it is during the lifetime of the assessee, but after he has reached at least 60 years and stopped making payment, no reversal for the assessee. Then earlier we used to say that if the assessee during his lifetime, if the dependent disabled relative predeceases, then money will come to the assessee from the scheme. This money will be taxable for the assessee because the dependent disabled relative has predeceased the assessee. Now we are saying even though the dependent disabled relative predeceased the assessee, but he predeceased after taking the money from the scheme, then for the assessee there will be nothing taxable, no tax implications. Alright, I hope now section 80DD is crystal clear for you. Okay guys, so I think with this we come to an end to the amendments in chapter 6A. We first had a small tiny amendment in section 80CCD where we said that 80CCD subsection 2 will allow 14% maximum not only for central government employer but also for state government employer. Second amendment was in 80DD. In 80DD, all these amendments in 80DD have come into the picture because of adding another scheme. We are also allowing those schemes now where the dependent disabled relative is getting money during the lifetime of the assessee, but after he has reached at least 60 years of age and has stopped making the payment. Alright, so with this we come to an end to this video. In our next video, we are going to be seeing the amendments in the TDS chapter. Alright, thank you guys.